Welcome. My name is Carol Kariuki. I am the CEO at Ichiban Tax and Business Advisory, and it was our pleasure to have you here for this quarter's TaxCraft, where we get to look into the happenings of the tax environment in the last quarter. There's been a lot going on. Top on our minds, of course, is the Finance Act 2025. But over and above that, we also have several developments that were not in the Finance Act. To help us go through this will be my colleague, Robert Wariru, as well as one of our tax advisors, Christine Nderitu. As today's TaxCraft is pretty heavy, we ask your indulgence that rather than take our usual 40 minutes, we will take 50 minutes. However, should you need to drop off at the 40-minute mark, the recording will be available on our YouTube channel, as well as our other social media sites within a day or two. So welcome to the session. As we continue, we invite you to put your questions into the chat, and we will be able to get to them once we are done with the presentation. So handing over now to my colleague, Robert.
Excellent. Thank you very much, Carol. Please confirm that you can hear me.
Yes, it can. Thank you and welcome.
Excellent. Thank you. Thank you very much. And good morning, ladies and gentlemen. Welcome to the Q2 TaxCraft call. And indeed, like Carol says, a lot of developments, especially around the Finance Act, and that's what we'll be going through this presentation. So if I can just get this going. So in terms of outline of the discussion, we're going to look at the developments for the quarter. What is the outlook for 2025? Because there are a couple of things that have already taken force or come into force, and then also recent case law, as always, because we want to see what are the courts saying, what are the tribunals saying, how should we plan our businesses. And then, like Carol says, we'll have a question and answer session where we can debate some of these proposals, especially around the Finance Act, because some of them are very, very problematic. Now, just getting straight into it and setting the scene. From a budget perspective, you'll all recall that in June we had, that's 12th of June 2025, we had the National Budget Policy Statement presented to Parliament, and that was the first one for FCPA John Mbadi. Now, following that, we had the debate around the Finance Bill, and the Finance Act was eventually published, was signed into law on 26th of June 2025. However, ladies and gentlemen, even though it's dated 27th of June, this document only became available to the public this week. So it's a bit of a problem because some of the proposals actually came into force on 1st of July. And so there's a question about how do I even comply with some of these proposals or some of these provisions, yet I did not even know about it. We'll also then discuss about the electronic rental income tax solution or system that Kenya Revenue Authority launched in the quarter, as well as the developments around the motor vehicle current resale selling price, which, as you probably know, has got a big problem and is currently before the court. So we'll come back to that in a minute, but let's just dive straight into the budget policy statement. Now, for the year 2025-2026, we're talking about a budget of about 4.2 trillion shillings. And we've done a comparison there between the previous year, that is the year ended June 2025, and the current year. And the key number that you can see there is the revenue. So we're talking about collecting 3.32 trillion shillings in terms of revenue, and that is made up of 2.7 in terms of ordinary revenue, 2.7 trillion in terms of ordinary revenue, that is your taxes, and then about 560 billion in terms of appropriations in aid. Now, what that tells you is that the appropriations in aid has grown by about 100 billion, and so we can expect that government services will be a bit more expensive. You'll be paying for a lot more of these government services. But the other thing to note from those numbers, ladies and gentlemen, is that if you look at our recurrent expenditure, that is our salaries, repairs and maintenance and so on, if you look at that recurrent expenditure, it is actually higher at 3.1 trillion. It's higher than our ordinary revenue, which means even if we collect all the taxes that we can, 2.7 trillion shillings, we are not able to pay for our recurrent expenditure. Forget about development expenditure. And that tells you that we're in a bit of a tough space. And indeed, the CS National Treasury has been on record as saying that until 2034, we will have a bumpy ride in terms of our economy. But having said that, at least the deficit has come down to 923 billion this current financial year from 997 billion last year. But a good thing that we learned yesterday from the Kenya Revenue Authority release was that the Kenya Revenue Authority collected 2.571 trillion shillings, and I think that's commendable given the economy that we are in. They did actually exceed their target. There you can see their target initially was 2.5 trillion, so they collected about 71 billion shillings more, which I guess is a good thing from an economic perspective. We only hope that they use those taxes appropriately. Now, in terms of the changes that we have seen, what are the key changes? One is that employees will be much happier people. Why? Because the per diem limit has been increased to 10,000 shillings. You'll recall that previously it was 2,000 shillings per night out or per day out of your usual station. Now it's 10,000 shillings. You don't need to account for the 10,000 shillings. It is not taxable on the employee, and it is a tax allowable expense on the employer. That's a good one. The other thing that we have seen is that employers are obligated by law. It is now a legal requirement for you to give your employees the deductions, the reliefs, and the exemptions that they're entitled to. So, things like insurance relief, mortgage interest deduction. You are required to give your employees those ones every month as you're computing their payroll. And the whole idea here is, let us ensure that the employees do not have tax refunds or tax credits when they file their tax returns. And I think that that's really a good move, so that we simplify the return filing process, and also we don't have refund claims being claimed by the employees. A not so good one was the reintroduction of tax loss capping. Now, what happens here is that if you've got a tax loss, previously you are allowed to carry that loss forward indefinitely, but now they've brought in a cap of 5 years, although you can apply for an additional 5 years from the Cabinet Secretary for National Treasury. So this one we think is going to be a bit of a problem from an investment perspective, but we'll wait and see. Another good change that we have seen is if you apply for a change of year, and meaning that if your year end is say September and you want to move it to December, previously the commissioner had been given 6 months to respond to you. Now commissioner has got 3 months to respond to you, and if they don't respond to you within 3 months, then you assume, or the law presumes, that your application has been approved. I think that's a very good change, because we have seen a lot of issues from a ledger reconciliation perspective where the change of year end has not been effected on time. So that's a really good change. Another change that we have seen of clarification is the introduction of 0.5% withholding tax on supply of goods to public entities. What this means is that if I supply goods to a parastatal, for example, then that parastatal has to withhold 0.5% as withholding tax. It's a form of an advance tax for the government. And this one will be in addition to the 2% withholding VAT and any other tax that may apply. So if you are dealing with the public entities, it's a good thing to know that from a cash flow perspective, you may be potentially impacted. Another good clarification that we saw was the removal of the 5 million shilling threshold for significant economic presence tax. Now, significant economic presence tax is basically the digital services tax, the tax that these big tech companies are required to pay for income that they derive from Kenya. When you talk about big tech, you're talking about the Googles, the Metas of this world, the Amazons. So previously, this provision said if you're earning 5 million shillings or more. Now, it was not very clear whether this is from Kenya or outside Kenya or globally. We presume that it was globally. And so removal of that threshold was quite a good one, even though this provision came into force on 27th of December 2024. So a bit of cleanup there for taxpayers. Another good one that we saw was the pension cleanup. Now, there are a lot of changes around pensions, but the key ones is if a pension scheme pays the benefits to the beneficiaries of a deceased person, then those benefits are not taxable on the beneficiaries, and that really is a good thing, because then you're not taxing the people who've gone through grief. But another change that we have seen around pensions is the exemption of taxation of gratuity. Now, the only problem, ladies and gentlemen, is that the way that provision has been worded, it's not very clear, because it's coming under paragraph 53 of the first schedule. Paragraph 53 talks about exempting pension payments. Now, the question that we're asking is, legitimately, can a pension scheme pay a gratuity, or is it employers who pay gratuity? So in terms of how that has been effected, we think that there's a problem. Even though speaking to KRA, they are very clear that gratuity payments will be exempt from tax. Now, probably that gives us a very good tax planning opportunity. You know, I just need to pay myself, instead of paying myself a bonus, I just pay myself a gratuity, and the gratuity is not subject to tax. So probably we expect a bit of cleanup around that, especially when Kenya Revenue Authority recognizes that there might be a bit of tax planning room there. If you construct a public sports facility, then you are allowed to take a deduction of that expense, which is really a good, it's a good change here. Lastly, we saw something that was not in the finance bill, but featured in the Finance Act very, very prominently. And this is a change in the taxation regime of the betting sector. Now, previously, if I placed a bet and I won, then we would be taxed on 20% of that winning. And also I would be paying excise duty at 15% on the amount that I have bet. Now the change is I'll only pay tax on winnings if I withdraw them from the betting wallet. And by the way, that withholding tax has come from 20% to 5%. So this is an interesting one. Why? Because this sector, if you remember, is the one which started real-time tax reporting. So it's very interesting to see how government is migrating the taxation of this sector, and we wait to see the impact from a revenue perspective. But the key change here is you pay 5% withholding tax on the amounts that you withdraw. Of course, there's an issue, because if I deposit in the betting wallet and then I don't play and I deduct and I withdraw, it's a withdrawal. So it's still subject to tax. So are we taxing the capital? I don't know. Some of the other changes that we are following up is we've seen is the removal or the repeal of the provision that exempted a third of the income. Previously, what happened is that if you are a non-Kenyan citizen and you're in Kenya working for an NGO, then you're in Kenya for at least, you're out of Kenya for at least 1/3 of the time in a year, you are allowed to take a deduction of 1/3 of your income against for tax purposes. So that has been removed. I don't know, I've not seen it really being implemented in practice, but that has been removed. Another change that we saw was 3% digital asset tax being repealed. The finance bill had proposed to reduce the rate to 1.5%, but in totality, now the tax has been repealed. Again, it's one of those things that we're asking. You know, this thing came in September 2023. Now it's barely 2 years and you've already removed it. So tax stability, that's a conversation to be had. And another one that we saw was a removal of the specified sources. You know, the Income Tax Act said the 7 specified sources of income. So the number 7 has been removed. So you can have as many specified sources of income as you probably can think about. So we expect that maybe the commissioner will utilize this provision to say, this is a specified source of income, and therefore we want to tax it separately. It will be interesting to see how that is implemented. Then we've also seen quite a bit of changes around timelines. And the first one here is if you are applying for a tax exemption, previously the commissioner was required to respond to you within 60 days, but now that period of 60 days has been expanded to 90 days, probably to give the commissioner a bit more time to do a bit of due diligence and to review the application in totality. So 90 days now going forward. And by the way, these changes, only of the 63 changes in the Finance Act, only 2 changes are taking effect on 1st of January 2026. Everything else is taking effect on 1st of July, or took effect on 1st of July 2026. And then lastly, as you can see there, there's an exemption for capital gains tax where a transfer of assets is happening. This is things like land is happening within an SEZ. So provided those SEZs are licensed, then that transfer will be exempt from capital gains tax. Other changes, reduced the rates for entities that are certified by the Nairobi International Financial Center Authority, NIFCA. And you probably remember seeing the president in London, I think it was last month, where he was inviting certain entities to come and invest in Kenya. And part of them was to invest in NIFCA. Now, if you invest, and there are quite a number of requirements, including the minimum investment being 3 billion shillings. If you invest in NIFCA, then you pay 15% corporate income tax. Compare that to your normal 30%. So you can see there's quite a benefit there. And then again, dividends that are paid by such entities, provided the entities reinvest 250 million shillings every year, then those dividends are exempt from tax. One of the questions that arises from this is, if you look at the medium-term revenue strategy, we're moving towards lowering the corporation income tax to about 28%, and then removing the reduced rates. But as you can see here, we've brought in new reduced rates. So in terms of policy implementation, again, there's a bit of a question there. Spectrum license fee. Spectrum license fee is what you pay or what telcos pay to Communication Authority to get the license in order to broadcast or to use frequencies. And so there has been an issue about if I incur a spectrum license fee, do I get to deduct it in the year that I incur or over the 5 years license period? And now it's been clarified that you deduct it over the 5-year license period or the license period on a straight line basis. This was a big issue in 2013 when Airtel had an audit with Revenue Authority, and that was a big fight as to whether it could be deducted straight line or one-off. A good change that we have seen from an income tax perspective is advanced pricing agreements. Now, advanced pricing agreements is around transfer pricing and certainty, where you go to the commission and you say, these are my transactions with my related entity out there. I want to agree on a price today for the next 5 years. So we are waiting for the regulations to see how this will be implemented, but this is one of the changes that is taking effect on 1st January 2026. And by law, the commissioner is required to provide those guidelines within 6 months after the coming into force of that provision. That means by July 2026, we'll be seeing those regulations. So that's a highlight of the income tax changes. Now, from a value-added tax perspective, quite a number of changes. And the first one that you can see there is a clarification that a tax invoice has to be an eTIMS compliant invoice. So whether or not you're VAT registered, now a tax invoice is an eTIMS tax compliant invoice. And allow me to say one of the things that we expect Revenue Authority to do. You all filed your tax returns for the year 2024. Very well done. And you probably took expenses. What we understand Revenue Authority is going to do is that they are going to look at your returns and say, we have looked at the eTIMS returns from various suppliers, but we note that we cannot see these expenses attached to your PIN. So please provide us the eTIMS compliant invoices. So we can expect a bit of a challenge there. And then for the year 2025, what they are planning to do is, if you don't have an eTIMS compliant invoice, then you will not be able to claim that expense. I don't know how they're going to do it, but that's what we understand they're planning on. Again, from a refund timeline perspective, the refund timelines have been increased from the 90 days to 120 days if you don't have an audit, and if you have an audit, from 120 days to 180 days. What that means, ladies and gentlemen, is that it will take you a bit longer to get your refunds, which is probably not the best thing. A good thing from a VAT perspective is that bad debts, you're now allowed to claim VAT on bad debts if the bad debts are for 2 years. Previously it was 3 years. You had to wait for your bad debt to be outstanding for 3 years for you to claim your VAT back. But now it's 2 years, and one hopes that they're going to align those 2 years even for corporate income tax purposes, so that I don't have to prove that it's a bad debt after 2 years. It's a good one. And one other one that we have seen is KRA can claw back the VAT exemption if you misuse the goods that have been exempted. I don't know how they are going to determine that you've misused those goods, but probably they will see how regulations around that will come through. But that's a concerning one. Lastly, a good one there is that for tea and coffee packaging materials, now they enjoy the VAT zero rated status, but of course you've got to get an approval from the CS, National Treasury and Agriculture. But if you do get that, then probably it will be easier and cheaper to pack your tea, which is a good change. The other changes very quickly from a VAT perspective, and this one was not in the finance bill, but it's in the Finance Act, was the VAT exemptions on mosquito repellents, inputs, and their machinery and raw materials to manufacture those inputs. And so the idea here is malaria is still a challenge in this country, and therefore let's support that sector. So that's a good one. The other changes that we have seen where things are moving from exempt to vatable include items or inputs for geothermal exploration, for example. So those ones will be subject to 16% VAT. I don't know whether that means that electricity will be a bit more expensive. I don't know, but they are now going to be subject to VAT. Previously they were exempt. Again, storage devices were exempt. Now they're moving to vatable, and raw materials used for manufacture of textile products, especially mattresses. Again, those ones were exempt. Now they're moving to 16% VAT. Those are the key changes from a finance perspective. It's also useful to say that there was a lot of attempts to remove things from the exempt listing to vatable and from zero rating to exempt, and that at least was not done. And so we're a bit happy about that. Otherwise, cost of living would have been a bit of an issue. From a procedural perspective, Tax Procedures Act, If you get an assessment from the commissioner, then the commissioner has to give you reasons. And the idea here is that you get reasons so that then you're able to object properly. Otherwise, without reasons, you can't object. So that's a very good one. And then the commissioner can now issue agency notices in respect of non-resident persons. Here, think about a scenario where say Meta owes Kenya Revenue Authority some money, and Meta has got somebody like a bank in Kenya which they collect money from. Now, KRA can write to the Kenyan bank and say, you owe Meta some money. Please don't pay them because they have not paid us certain taxes. They have not paid us significant economic presence tax, for example. So that's the idea there. KRA can go after these non-resident persons from an enforcement perspective. A very problematic one is the new requirement. Again, this was not in the Finance Bill, it's in the Finance Act. If you're importing anything into this country, you have to have a certificate of origin. Now, this certificate of origin essentially says it's issued by the competent authority of the other country and says this good has been manufactured in Kenya, this is the value, this is the quantity, etc. There are 7 data points that you need to prove. Why is this a problem? Look at the imports that come into this country. A lot of them are coming from Dubai. Does Dubai manufacture any of these things? Probably not. So how will Dubai issue a certificate of origin? If these goods are coming from China, for example, China is not exporting into Kenya, it's exporting to Dubai. So why would they be giving you a certificate of origin for goods that are going to Dubai? This thing is going to be such a problem. And I've had a conversation with some senior KRA officers, and they said that they are going to clarify this because, first of all, it has come into force on 1st of July. And secondly, if you don't have this certificate of origin, by law, the penalty is the commissioner confiscates your goods. So I really don't know how this is going to be implemented, but it's a big problem. Even though administratively, they have indicated that they are going to postpone the implementation to September, because also don't forget, there are goods which are already en route, they're in the high seas, which probably didn't have this certificate of origin. So that's a big problem. However, coming from that problem, at least we no longer have convictions for failure to withhold VAT. And again, also, if somebody has already accounted for the tax that you should have withheld, then the Kenya Revenue Authority cannot come to collect that same tax from you, which really is a good thing. It avoids double dipping. The commissioner can waive penalties. We've already seen the commissioner recommending or committing to waive penalties for the people who filed on 1st of July as a result of iTax failure. So that really is a good provision that came in. If we talked about the timelines for overpayment of applications, and by the way, it's so important for us to clarify here in terms of recent developments. If you have an overpayment adjustment voucher or a refund adjustment voucher, what they call RAVs, administratively you cannot utilize it against withholding tax and PAYE. That is an administrative issue, and I understand that KRA is engaging National Treasury around that. But the point there is that those timelines have been increased, like we said, from 90 to 120 days. If you file your objection late and it's admitted, then the commissioner's time starts running from the date that you lodged that application, which is a good one. So those are the key changes from a finance perspective, tax administration or tax Procedures Act perspective. Very briefly, a huge raft of changes from an excise duty perspective. One, we shall be using the tariff codes in the East Africa Community Customs Management Act. That's a good one. Secondly, we have seen a huge change in some of these rates. Now, you'll see 35% has not changed, that the ad valorem rate of this duty has not changed. However, the cash Kenya shilling value has changed. You can see that it's coming from 200 shillings per square meter to 500 shillings per square meter. And float glass, by the way, is what is used to build buildings. If you look at buildings with this shiny glass, that's float glass. So it's going to be very expensive. And the same thing we've seen with carton boxes. 25% remains, but the rate is coming from 75 to 200 shillings per kg. And then we've also got new things that are being subjected to excise duty, imported teas, whether they are flavored or not, 25%, safety glass, again, coming in at 35%, and aluminium, which means that construction, especially for factories, will be a bit more expensive because a lot of people are using aluminium. Building, we use a lot of aluminium for windows. So that comes in at 25% or 400 shillings per kg, whichever is higher. So you can see excise duty has been, there's been a serious change there. Other developments that we are tracking, we talked about the introduction of eRITS. Now, this essentially says, I will look for the rental properties wherever they are. I will geotag them. And because the property, you sell your house, but you don't move your house. So once KRA geotags you, then they'll be expecting that you'll be paying irrespective of who is occupying that house, provided it's still yours. So the idea there is to enhance compliance in this sector. Again, effective 1st July, when you immediately after you fuel your car at the petrol station, once the attendant returns the pump to the handle, or where it receptacle where it stays, then automatically an eTIMS invoice is issued. So for those of you who require eTIMS invoices that have your PIN, you need to advise the fuel attendant so that immediately they do that, and you give them your PIN so that immediately they do that, then they can issue you an eTIMS invoice. Then from a customs perspective, we've also seen introduction of the independent review of objections office. This is really good because customs matters were hardly ever resolved in the alternative dispute resolution. So effective 1st of August next month, we expect that will be we'll have alternative dispute resolution for customs matters. And then we also talked about the current retail selling price, which the High Court has currently stopped. Essentially, KRA is saying we have increased the values of these imported vehicles, which, by the way, now you will need a certificate of origin for it to come in. So we've increased that value, and therefore we expect to collect a lot more duties. Probably explains why customs performed at 107% in the just concluded financial year. We are following that story, and we'll let you know. Other key developments, you remember in April, the High Court declared the requirement to re-register national NGOs under the Public Benefits Organizations Act as unconstitutional. And the whole idea there was, we are already registered. Why do we need to register? And why do we even need to disclose certain information? So at least that has been stopped, and that probably is a good thing. We've also seen a huge debate around the special table, and essentially the court has said, stop. Let's have a look at this. But remember, KRA is saying that this special table is the one that has caused VAT to perform at 14% growth. So there's a bit of a debate to be had around that, and whether KRA is actually using this properly to go after the tax evaders. And then lastly, we have the Social Health Insurance Fund contributions about is it a double taxation, especially because it's coming from your salary? And the High Court did find that it is unconstitutional on account of being double taxation, but the High Court has not given us direction. They are waiting for the decision of the Court of Appeal. So we're also waiting for that decision to see how we'll deal with that. Further afield, two critical things. One is Nigeria has had a lot of tax reforms, and one of the good reforms around Nigeria is that we now have the informal sector being exempted from tax. And this is based on a study where Nigeria was saying about 97% of the informal sector, it's not worth it to collect tax from them. So let us support them, let us grow them into the formal sector, but for the time being, let's not collect tax. That's really a good one, and I wonder whether this is something that we shouldn't look at as a country. And if you look at the Uganda Finance Act, it's the same thing. SMEs have been exempted from tax for the first 3 years. The idea there is, let us grow these guys into proper paying taxpayers, and then we can tax them and we can track them as we go along. So that's a key change from a Uganda Tax Finance Act perspective. South Africa performed very well in terms of revenue collection. Actually, they exceeded their targets. And the question there that we probably are posing is, what is it that they are doing that Kenya Revenue Authority ought to be doing in terms of collecting taxes so that we can get to about 24.5% of our GDP? Remember, our tax to GDP ratio is about 14%, so we are quite far out. And then lastly, the US also introduced a 5% excise duty on remittances. Remember, remittances account for a big portion of Kenya's foreign exchange earnings. What does that mean for Kenya? Will we see reduced remittances? Will we see a bit of instability in terms of foreign exchange because of the lower remittances? This is what we are watching. So, ladies and gentlemen, that's a wrap up of the developments that we are watching. And allow me to invite my colleague Christine to take us through case law. Christine?
Thank you. Thank you so much, Robert. Indeed, it has been an interesting quarter. We have seen a lot of changes, both in the Finance Act, as well as also the additional legislations that are just coming in. From a case law perspective, we've also seen a lot of decisions being dealt with, both at the High Court and also at the tribunal. For instance, we saw the case of the Commission of Domestic Taxes versus Tech Savannah Company Limited. Tech Savannah Company is a company that outsources software developers, mostly to the major companies like Safaricom. And the question in this case was whether or not that outsourcing is a taxable supply for VAT purposes. According to Tech Savannah, and both at the tribunal, the tribunal and TaxSavana held that the outsourcing arrangement is not a VAT taxable supply because it is merely a disbursement of money that TaxSavana pays these developers the amount of money that Safaricom or any other major company would have paid them as a salary, and therefore it should not be subjected to VAT. But in this case, the commissioner then appealed that decision to the High Court. And at the High Court, what is interesting is that we saw the High Court go into the terms of the agreement, which meant that the court was actually examining the facts of the case. And in examining the case, it said that the amount that TaxSavana is being paid, because it is paid a lump sum amount by Safaricom, and then it then goes ahead and pays those amounts to the developers, that amount that it receives from Safaricom is because it's supplying a consultancy or a professional service and should therefore be subjected to VAT as the whole amount. What is quite interesting about this case is the fact that in the last TaxCraft, we dealt with the case of Vivo Energy Uganda versus the Ugandan Revenue Authority, and there we were talking about what constitutes a disbursement and what constitutes a reimbursement. Why we did not see this in this case is not something that we are able to comment on right now, but in case you missed it, you can go and watch the video in our YouTube channel. For the next case, we also saw the case of the Commissioner of Customs and Border Control versus the Coffee Management Limited. This was a question on whether or not Coffee Management, in its position as the appellant in this case, had filed the appeal properly before the court. Why was this question arising? One, Coffee Management filed its memorandum of appeal within the 30 days time frame, according to Rule 5, but it had failed to actually include the record of appeal in that memorandum of appeal. Now the question became, was that memorandum of appeal complete for purposes of an appeal? Of course it was not. But then 6 months later, Coffee Management got the record of appeal and filed it before the court. It went before the deputy registrar, and the registrar admitted the record of appeal into the appeal procedures. The question was whether or not the deputy registrar, in her own powers, can be able to grant leave as a procedural matter, or whether seeking leave is a substantive matter that should be dealt with through an application under Rule 4 of the Tax Appeals Tribunal rules to the High Court, and therefore Coffee Management should have actually filed an appeal that should have been heard by the court. The court dismissed this appeal on the basis that the Coffee Management had not sought actual leave, and therefore the rule 4 was applicable because leave is a substantive matter, not a procedural matter, to be dealt with by the deputy registrar. For the next case, we talk about the Kenya Roads Board versus the KRA. In this question, the question was whether or not Kenya Roads Board, which has a fund, the Kenya Roads Board Fund, is actually supposed to be issued with a PIN, and whether the amount that Kenya Roads Board Fund collects in terms of the toll and in terms of the fuel levy is subjected to income tax. Why is this interesting? Is because, for one, Kenya Roads Board invests this money further and gets an interest payment. For that interest payment, it was paying a withholding tax. The question was whether or not, now for the additional 25% that remains, should there be a payment of the income tax of the amount? The TAT dealt with this matter and stated that the amount that Kenya Roads Board Fund is even raising, in itself, Kenya Roads Board Fund should not have a PIN, and therefore it does not qualify as a corporate person. When you look at the definition of a corporate person, it includes a company and all that, but it doesn't include the existence of a fund as a corporate person, and it cannot therefore be a separate entity and get a new PIN. Therefore, KRA was ordered to delete or remove the PIN for Kenya Roads Board Fund and only have Kenya Roads Board as the only taxpayer. For the next case, we also talk about the case of CIPLA Kenya Limited versus the Commission of Domestic Taxes. The question here was a transfer pricing issue. Transfer pricing has been quite an issue for the past few years, and that's why we probably are seeing the introduction of APAs. For this case, the question was whether or not KRA can come in and impose a median rate. What happened was CIPLA Kenya Limited has a related entity, which is CIPLA India. But CIPLA Kenya have a transfer pricing agreement, and on the terms of the agreement, CIPLA Kenya had actually been receiving or paying the amounts at 3%. KRA came in and said, you have done your transfer pricing. We see that. We see the documentation, but the range ranges from 1% to 9%. The median rate for that should then be 5%. The question is whether KRA should have been able to impose that 5%. The tribunal relied on the provisions of the OECD guidelines, paragraph 3.62. This specifically provides that a taxing authority can come in and introduce the median rate only where there are unknown comparability defects. But because KRA was stating that, you know what the defects are. The defects being you're comparing veterinary substances to pharmaceutical substances in coming up with your transfer pricing rate. And therefore, because KRA was able to establish the actual comparability effects, it does not qualify under paragraph 3.62 of the OECD guidelines for then KRA to come and impose the new rate. And on that basis, the appeal was dismissed. For the next case, we talk about MultiChoice Kenya versus the Commission of Domestic Legal Services and Border Control. This was a case where MultiChoice Africa has a tax representative, which is MultiChoice Kenya. But the thing that MultiChoice offers is what we call DSTV, Showmax, GoTV, all that. The question is whether or not the services that MultiChoice offers, are they services that are digital services and therefore subjected to the DST guidelines, or are they radio and television services and should be falling under paragraph 87 of the VAT Act. In terms of that provision, we talk about paragraph 57, which now talks about what are the services that are subject to DST. And for that, it's a service that is offered over the internet. For this specific service, it was the content or digital content that is offered over a platform. What we did not see in this case is the question of what exactly is a digital marketplace. That definition is in the regulations, but we did not see the Tax Appeals Tribunal going into the details of that. But on the basis that the service is offered on a digital platform, the service was classified as a digital service. And because MultiChoice was claiming its input VAT, it could not get that. Why? Because under the DST regulations, a person that is registered or a foreign entity that is registered under those regulations cannot then claim the input VAT, even though it has an output VAT. And on that basis, the appeal was dismissed at the tribunal. We also saw the case of LSK versus the National Assembly. This was a case where we were talking about whether or not LSK had the proper grounds in challenging the Tax Procedures Amendment Act 2024. The question here was because in the Tax Procedures Amendment Act 2024, the KRA had brought in a provision that said that the classification of steel products or steel billets are supposed to be moving from the current HS code, which exempts them from import duty, to a HS code that imposes import duty. But under the East Africa Community Customs Management Act, the steel billets are not subjected to import duty. That contravention was what brought out this case. The LSK went ahead and said the inconsistency between the local or the national legislation and regional or multilateral treaties should have a precedence where the regional or multilateral treaty takes precedence. But the High Court in this case had a different view. And in determining the arguments for this case, the court relied on the case of Mitubel, which was a Supreme Court case, and said the local legislation, in as much as our Article 2.5 and Article 2.6 of the Constitution talks about international legislation forming part of our legislation, our local legislation takes precedence over whatever is in the treaties or whatever is in the multilateral treaties. And on that basis, the appeal was dismissed. The last case that we'll be dealing with is KRA versus CIC Insurance. This was a High Court case, and the question here was whether tied insurance agents are deemed independent contractors and not subjected to PAYE. Why is this interesting? It's because for the issue of tied insurance agents are basically the agents that you have working for a specific insurance firm. And they are usually under control of that firm, but the definition of an agent has been defined only in the Insurance Act. KRA relied on the provisions of the Income Tax Act and the Employment Act, completely ignoring the provisions of the insurance agent or the agent in the Insurance Act, which says you are an agent who receives a commission, but you are not an employee. And on that basis, KRA was appealing this matter and seeking to have insurance agents defined in the not defined in the Income Tax Act and the Employment Act to be presumed to be employees. We've seen this matter again in UAP, we've seen this matter again in Liberty Insurance case, as well as Kappa Oils. And in all those cases, the High Court dismissed the appeal on the basis that there's no definition of agents in those two acts, and therefore the definition of agents in the Insurance Act should take precedence. Just as well as in this case, the appeal was dismissed on the basis that the KRA had not proved the case that an agent is actually an employee. I believe that brings us to a closure of the cases. Back to you, Robert.
Thank you very much, Christine. Thank you for that update. Now, very quickly is just some of the things that we've already touched on. You can see the current retail selling price notification by KRA there, and as well as the excise duty regulations. So we are expecting those ones, and we'll say more about the CRSP once we have direction from the court. Then yesterday, you probably must have seen this public notice around the fringe benefit tax rates. An interesting one is that it's now 8% for fringe benefit tax, which is now payable at 30%. The law has also been clarified around that, and deemed interest rate at 8%. But if you look at the low interest benefit rate, which is for loans that were acquired a long time ago, you can see that the rate is 9%. So one, it's higher than the normal one. And then two, it's been given for the rest of the year. So just take note of the fact that the low interest benefit rate at 9% applies for the next half of the year, whereas the others are quarterly. Now, in terms of outlook, what do we expect? Next month, we expect the budget review and outlook paper, which is basically a report card. This is what happened in financial year 2024-2025. These were the lessons, these were the good things, and these were the bad things. So that's a paper that we are looking forward to reading once it's published by 15th of August 2025. Second one is that it will inform the sector working groups and the 2026-2027 budget, because this is where the budgeting process starts, and we expect to see that public notice inviting comments around the budget in the coming quarter. Do we expect KRA to be aggressive? Absolutely. One of the changes that is coming into force on 1st of January 2026 is the advanced pricing agreement, like we said. And then the next one is the one that says 20% of the import declaration fee will be put in a special fund. Now, of that 20%, half of it, or 10, will go towards paying Kenya's obligations, international obligations to AU. And the other half, or 10%, will be used to fund revenue enhancement measures. So Revenue Authority will have a kitty that it can then use to go after taxpayers and ensure compliance. So if you look at that, if you look at the developments that Revenue Authority is talking about, including that you can issue an invoice using WhatsApp, very interesting development there, including, and this is a very important one for us to understand, that for the PAYE for July, everybody will have to use the simplified PAYE return. You will not be able to use the normal return that you used to pre-fill. So you have to use the simplified PAYE return. So we can see a bit of enhancements by Revenue Authority to the iTax system, and all geared towards trying to get as much data as they possibly can. There are a lot of integrations that they are working with ISASA, with other regulators, so that they can pull out that data and enforce compliance. Bottom line is, we expect a very, very aggressive Revenue Authority in the quarter. And that, ladies and gentlemen, brings us to the close of the highlights for the quarter, and I'll hand it back to Carol. Carol?
Thank you very much, Robert, and thank you, Christine. Indeed, very enlightening. And as I had said at the beginning, indeed, a very packed quarter it has been. We are taking questions now. I can see there are already a couple on the chat. Please feel free to put in other questions. Just in case we are not able to get to your question or you have one later on, please feel free to write us. Our email addresses will be coming up on the screen. You may write to any of us and we will get back to you. As we draw to a close, we will also be putting in a link for a survey. Please take the survey, let us know your thoughts, and help us make TaxCraft even better. So off to our first question. As they say, the devil is in the details. Hitesh wants to know, will the gratuity exemption be supported in the July 2025 returns? And on that, also affecting the gratuities, it looks like the gratuities are pretty hot. So I'll just take all three questions on the gratuity. Is this going to allow those who have not yet reached the retirement age to take the benefit of the exemption on the gratuity? And is it also applicable on gratuities that are as a result of a bargaining agreement? Robert.
Thank you. Thank you very much, Carol, for those questions. And thank you, Hitesh. I think, Hitesh, I need to come for a cup of tea so that we can discuss about this gratuity issue. But we expect that the iTax will be updated. Actually, one of the reasons why iTax was a problem on 30th of June was that they were trying to update the changes that were taking effect on 1st of July. And that caused a bit of the system downtime. So I expect that will be completed if it's not already completed, so that then the gratuity payments are clearly exempt. And by the way, one of the things that Revenue Authority will also do, and the reason why they're asking you to use the simplified PYE return, is that once you give them that data, the system will automatically do for you a PYE recon, so that if you are not disclosing the full cost versus what you've declared in your accounts, then you'll have a problem. And this means that for those of us who've got casuals or people who are under the tax threshold and we don't disclose those people, you need to disclose that so that your POIE cost, your gross payroll cost, ties to what is in your accounts. So that's an important point. So I expect that they will update iTax on that. And then to Albert, my other good friend, it's really a badly drafted provision, because it comes in under paragraph 53, which talks about pensions. And the first question we ask is, do pensions even pay gratuities? My understanding, and I'm happy to be corrected, but my understanding is that you could either contribute to a pension or your employer makes a provision for a gratuity payment. And this one is really around collective bargaining agreements and people who are on contract, like senior employees who are on contract. So at the end of your contract, you get paid your gratuity, say for example 31% of your gross salary for the period. Now that amount is what is being referred to as a gratuity. So if it is a gratuity, probably it will not be paid by a pension scheme, but yet it has come in under paragraph 53, which is exemption for gratuity for pensions. However, my reading of the law is that a gratuity is exempt. So how they implement it, it should be exempt. And so probably this is why I said that we all need to look at our contracts and figure out whether we qualify for gratuity and pay ourselves gratuity and not pay tax on that. At least that's what the wording of the law suggests. Carol?
All right. Thank you very much. Question here around the per diems. So it's very good news to hear that the amounts have been increased. Question is there a differentiation with per diems that are applicable outside the country if somebody's traveling outside the country, or does it remain the same amount?
No differentiation, Carol. So it remains the same amount. And one of the things that probably taxpayers need to do is use the law to write to the commissioner and say, these are our rates for international per diems. Can you please approve that we are not, these are not going to be taxable benefits? And we've seen the commissioner in several instances approving that, and this is in line with the SRC scales. So you can say SRC government is already benefiting from this, so why shouldn't the private sector benefit from this? So no differentiation, but you have a leeway. And one other question that I have seen Albert had asked, whether the gratuity applies for people who've not met the retirement age. Again, big problem, because paragraph 53 has got those conditions for retirement or you have contributed for 20 years. Gratuity is coming in there. So do payment of gratuities also have to follow those requirements? It would appear it would, because it's under paragraph 53, but again, gratuity, you access it at the end of your contract. So those are some of the challenges that you are grappling with. Carol?
Thank you very much, Robert. Okay, and Eric wants to find out a little bit more about the 50% tax rebate on employment when you take more than 10 interns. Is this something that applies automatically? Do we need to engage the Director General of NITA? How do we go about getting these rebates?
Yeah, that's a good question, and it's that provision came in quite a while ago, Carol. I'd need to have a look at the regulations, because there are regulations that were published, but you would need to get approval or notify the Director General of NITA, because then they will then confirm these are the interns that you have, and therefore when you're paying tax, you need to exempt them from this. And the other thing is, and we can take Eric's email and respond to that specific question, because remember, when you're filing your POIE, the POIE system doesn't know that you've got interns or not. So you need to engage KRA in order to ensure that the system does not automatically compute the taxes. But that's a question that we're happy to respond in detail separately.
Thank you. So we have time for one final question. So we'll take this from Samuel. And just going back to the per diem question, is can this be used essentially to reduce the travel expenses? So what I'm understanding here, Samuel, is if you have traveling expenses, is this counted as part of the per diem? Is it in addition to, can you have both? How is this going to happen? because then, of course, on the per diem, you don't need an eTIMS receipt, but for traveling expenses, you would need the eTIMS receipt.
Yeah, that's my understanding of that question, Carol, is so I am traveling to Mombasa. I get a per diem of 10,000 shillings, but then you have to pay for my SGR or my flight and so on. So the per diem is for my time out, not for the travel. So if I get to, unless you're talking about maybe taking a taxi here and there or ground travel. So my understanding is if you can separate those two and say, here's your ticket for the airline, go to Mombasa, but then here's your per diem, and you are not going to be taxed on that. But it's also useful to say different employers treat this thing differently, because you might find that somebody who gives you 16,000 shillings and then you sort yourself out on accommodation and food and so on and so forth. Somebody else says, I'm going to pay for your accommodation, I'm going to pay for your food, but then here's your per diem or allowance for your calls and your other personal expenses. So it really depends on employer to employer, but the law just says per diem of 10,000 shillings. So if you get your employer to pay for you all expenses and then you're paid for per diem, then you would still qualify in my view, because there's no qualification as to whether the per diem is used for this or the other. Carol?
Fantastic. Thank you very much. And that, ladies and gentlemen, brings us to the close of our time. We thank you very much for being with us, for staying with us through the time. And as we said, it has been a very packed season. Feel free to reach out to us on our email addresses or on any of our social media handles that are up on the screen. And we look forward to seeing you next quarter for TaxCraft Quarter 3. Karibuni sana, and see you all next time.